Hey, what's happening, options traders? Good morning once again. And in this video, I wanted to talk a little bit to the option sellers out there and to really make a point of why it's so important to think about opportunity costs. It's something that I find that nearly every option seller completely overlooks. So what's an opportunity cost and how is thinking about it going to help you make better decisions? Let's go find out. And as always, before we do, please be sure to click like and subscribe. It is super appreciated and definitely helps to promote the channel. So an opportunity cost, what is it? Well, this is really a term that comes from economics, and it's really the basis for there's no such thing as a free lunch. And an opportunity cost isn't necessarily cash or a check that you write. It's not an actual cost, at least not necessarily. Instead, it's the highest valued thing that you give up to accept another activity. And the idea is that you can't use the same resource twice. And at a very minimum, time can never be recaptured. So even though you might say, well, I could use the vacuum cleaner twice or the blender twice, yeah, that's true, but you can't use it over the same period of time. You're using it for one use, you can't also use it for another use over that period of time. So that's always a big one about time can never be recaptured. That's always at a bare minimum going to be one of your opportunity costs. So take this video, for example. If you're taking time to watch it, there are other things you could have been doing. Big list of things. But you might have said, well, I could have been having breakfast, or I could have been reading an article on CNBC, I could have been exercising, or maybe I could have been cleaning. Again, a big list. But out of this entire list, what's the thing that you valued the highest? Now remember, it doesn't mean the one that necessarily has the biggest dollar value. Might be hard to put a dollar value on it. It's a personal choice. Another way to look at it is, what would you have been doing had you not been watching this video? And whatever that thing is the opportunity cost. And so once again, that's why it's wrong to say, oh, this video is free, it's not costing me a thing. That's not true. There are things, and again, time at a minimum, that you have to give up. And so that's really the way that you need to change your thinking to make better decisions. And here's why. Very common among option sellers, because sellers focus on the credit received as if it's some type of free money. They go, oh, look, if I push this button and click sell, I can get $300 immediately deposited to my account. Well, yes, that's true, but why is somebody paying you that? It's because you are accepting an obligation. Remember, option buyers have rights, but sellers are accepting obligations. So the thing that you have to ask yourself is, what are you giving up? When you sell this option, whether it's a call or a put, what are you giving up? There has to be something that you're giving up. Why? Because that's what the option buyer is trying to buy. And so another thing from option pricing theory, which we've talked about, remember that the credit received is your expected loss. So if you sell an option for $3, the reason somebody's paying you $3 is that that's what you're expected to lose. And conversely, the person who pays the debit, that is their expected gain. This is why the options price is the fair value. The credit received is the expected loss and the debit paid is the expected gain. And you need to take this into account. So for example, let's take a look at a covered call. So here we've got shares of stock. We've sold the $100 call for $5. There's our bend at 100. Now we could have also maybe been selling calls against other calls, maybe a diagonal spread. Doesn't matter. Anytime you're selling an option, you need to not just focus on the credit. And yet really that's what most traders do. So in this example, we can see that the credit there is $5. So they say again, oh, I got $5 or $500 credited to my account. And they just never go any further with their analysis. But think about this. Had you not sold that call, you would have still been in control of the unlimited upside. That's what the option buyer is trying to buy from you. So yes, you are getting this credit, but you're giving this up. Now, yes, it's a question mark. We don't know what that amount is, but this is where the decision process comes down to. Don't just focus on the credit. Instead, be sure to ask if the credit is acceptable for what you're giving up. And again, I see a lot of traders that'll do this. They'll, especially going into earnings, and they'll say, well, I sold this really far out of the money option for 40 cents. All right, well, you got 40 bucks credited to your account, but look at what you gave up. And what if this stock does gap up 10% or more? You gave all of that up for 40 bucks. And remember, the main reason for doing a covered call is that this credit lowers your break-even point. It just creates a small downside hedge. Well, is that 40-cent credit really going to be a significant downside hedge? See, we have to ask, is it worth giving this up for this credit? Not just, oh, gee, look, I got some free money. And so if you start to think about opportunity costs, it will definitely help you make better decisions as option sellers. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.